Today we are going to talk about methods to reduce or avoid double taxation in an international context. Imagine you are the manager of a domestic corporation that expands business abroad in the form of a foreign direct investment and gains profits from it. In case of a simultaneous application of the worldwide and the territoriality principle, international double taxation occurs. To reduce or fully mitigate international double taxation, countries can adopt the credit or exemption method. In this video, we are going to talk about the tax implications if a country applies the exemption method. The exemption method applies to the tax base of the domestic corporation. Foreign income is explicitly excluded from the tax base of the domestic corporation in the residence country. Thus, foreign income is only taxed abroad in the source country. Now you wonder about the implications of the exemption method on the overall tax burden of the direct investment. We have to distinguish two cases. First, the domestic corporate income tax rate is lower than the foreign corporate income tax rate. In this case, the overall tax burden of the investment is determined by the higher foreign tax rate. Second, the domestic corporate income tax rate is higher than the foreign corporate income tax rate. In this case, the overall tax burden is determined by the lower foreign tax rate. As the exemption method excludes foreign income from the domestic tax base of the corporation, the foreign tax rate becomes definite. From a tax perspective, if the domestic country applies a higher tax rate, a foreign investment is advantageous compared to a domestic investment. In contrast, if the domestic country applies a lower tax rate, a foreign investment is less tax efficient as compared to a domestic investment. In addition, if the foreign country levies a withholding tax, this would become definite and would increase the overall tax burden of the investment. To summarize, under the exemption method the cross-border investment is only taxed in the foreign country. Thus, the foreign taxes determine the overall tax burden of the investment. Under the exemption method, double taxation is avoided. As an alternative to the exemption method, a country can apply the credit method. This will be explained in a separate video.